Yo YouTube, what's going on, my bro? Welcome back to Clinton Trades channel. So today I'll be talking about breaker blocks and how I use breaker blocks day trading. So hope you guys are doing well. Just sit back and pick your pen and notes because I'm going to drop some gem and my little experience on why I'll be using breaker blocks. So right here you can see a skeleton type of high. I did this. I hope it's not looking that. I think it's nice. It's nice though. I agree it well. So most ICT traders trade after a shift in structure, a break in market structure, and they just look for trades. They just click buy or sell. But in that the case may be. But now what we actually do, as what you actually have to do as an ICT trader, is you should wait for price to trade back to a PD array at discount level or premium level. Yes, you should wait a price to trade back at premium level or discount level. Yeah, you can see here we have a bullish breaker and we have a bearish breaker and a bearish breaker. And for a bearish breaker, I'll start for a bearish breaker. You can observe the short-term low. This short-term low is a failed order block. This short-term low is a failed order block. You can see price run past it. You can see at this point you can see this low is a failed order block. There's another block here that is failed. So you see price run through it, and it's also a short-term low. It's also a short-term low. So for a bearish breaker block, you have price trade past this low. That's the failed order. That making it a failed order block. And after price takes out the low, we'll have a structure shift to the downside. Yes, then you can see after a structure shift, you just have to wait for price to retest back to the last down close candle. Yes, to the last down close candle. I think why it's lagging. So after price break that short-term low that known as our failed order block, you need to let price to trade back to the last down close candle. For a bearish breaker block, you need to look for the last down close candle, not a last up close candle. It's a bearish breaker block. You need to look for a last down close candle. You can see, observe the short-term low. And also for a value breaker block, you need a liquidity sweep of highs. A liquidity sweep of highs. You need to look at when price takes out a high and also taking out the short-term low. It should not be an SMT. It should not be something like a failure swing. Maybe a high, this high at the right failed to take out the highs at the left. It should not be like an SMT. No, it should always you look for price to take out the high first and the low that we have a failed order block, or the short-term low instead. You get, this is a high probability bearish breaker block. And also need for price to retest back at the last down close. You can see it's just a skeleton. When we get to the live chart, I'll show you guys what I'm talking about. But when after price breaks market structure to the downside, that's giving you bearish order flow, that yes, we are now bearish. Then allow price to retest back. Do not just click sell after the structure break. Don't click sell after the structure break. Wait for price to retest back to the last down close candle that we have at this short-term low. Then you look for your sales. Then stop loss should be at the highs of the last down close candle. That's where your stop loss should be. It should be okay. Let me go down to the bullish break. I won't get to the live chart. I'll show you what I'm talking about now. On bullish breaker, the same thing. Observe the short-term high that we had there. Now let me give a scenario whereby this short-term high will be our failed order block. Why? Because when we have a structure break, at this downside, when price seeks liquidity at this downside, most times you have another block here. Yes, most times you have another block at this level. But now price failed to like trade to that other block and ran past that other blocks and also the short-term highs. At that highs also, it fails to get to that other block and run past it. That's how you call it a failed order block. You can see a failed order block. And also, as I said on bearish breaker, you need a scenario where the low at the left hand side, the low at the left hand side should be taken. Let the low at the left hand side be taken as a liquidity. It should not, like, let it not be a failure swing. Like I see the low at the right hand side, the low here did not like not fail to take out the low at the left. Sorry, I'm like camera shy. So you see at the low here, they failed to take out the low at the left. It failed to take out. But for a bearish breaker, you need the low at the left to be taken as a liquidity sweep. If you sweep liquidity, then also make a failure of, and also give a failed order block. You get? So now, if I get my phone back, okay. Now after we have a structure break to the upside, we have a market structure break. What we have to do is to look for the last up close candle at the short-term highs. After we have a structure break to the upside, we have a market structure break. What we have to do is to look for the last up close candle at the short-term highs. Price after the short-term up close candle, a short-term high, and also a up close candle at that short-term high. Price will break market structure to the upside, trade back to it, retest the breaker block, then stab. Then you look for buys. Don't just wait. Like you should not look for buy or sell after market structure shift. You shouldn't look for buy or sell after a structure shift. What you should look for price is that look for a up close candle after the break of market structure of the short term highs. They allow price to retest back to that up close candles that we just bring, that up close candle that we had. Then you can look for buys and stop loss at the up close candle lows. See, stop loss for bearish, stop loss at the short term, stop loss at the down close candle highs, and stop loss at the up close candle lows. So now we go to a live chart. Yeah, I'll show you guys how you can look for these setups trading the live market in a live chart. So let's go. So guys, here on the live chart, you can see we have a bearish breaker block. I think I'll just draw here so you can do it for if you should inverse scale. Fashion inverse scale is the same thing as bullish. So as I said, you can see here. Let me remove this. You can see here we had a high, a low, a higher high, then price shifted structure. You can see we have a low. You should always have a high, a low, and price taking out buy side liquidity, giving us a high. Then we'll now take out, then price is now taking out the short term low. That's a structure, a valid breaker block. Okay, you can see here we have price sweeping out Asian range highs. You can see price swept out Asian range highs. After price sweeping out Asian range high, we had the short term low right here, and price swept to liquidity and giving us a market structure shift to the downside, making us know that we are now bearish. So what they are now look for, you can see here at this level we had the last down close candle. Remember I said the last down close candle as a bearish breaker. So we had this low here giving us an up close candle, but look again, just look again at your left. If you have a bearish, if you have a down close candle, if you have a down close candle, you can see price. We have down close candle right here. Then you draw, then mark out the highs and the lows of that last down close candle. So I mark out the highs and lows of the last down close candle. then drawing out to the right, marking it out to the right hand side. After I mark out my bearish breaker, what do you see here? You can see this candle retested, price go trade back to this bearish breaker, then closed. Price traded back to the breaker, closed. We had an entry, then stop loss where stop loss will be at the highs of the down close candle. That's where stop loss will have to be. The highs of the last down close candle, the highs of the down close candle. Then that is it. You can actually target the minus 2.5 standard deviation. Can be your target, and stop loss will be at the highs of the down close candle. So I think that is it. If I should explain more, there's no need for more explanation. You just need to look for a high, a low, and also the breaker block is an entry, and it needs a model around it. You need context behind it. Maybe you can look for maybe a higher time frame, price straight to an FEG, another block, maybe price swept liquidity on higher time frame. Then you can scale down to an M15 chart to look for this. Do not forget, a breaker block consists of a high, a low, a higher high, then price taking out the short-term lows. For a bearish breaker, and also for you can scale down to a bullish breaker, price making a low, a high, a lower low, then taking out the short-term highs. You can look for a up close candle, a last up close candle, or a last down close candle, then price trading back to it, maybe the consequent encroachment of it, or just at the lows of the candle, retesting the back. Stop loss should be at the highs or the lows if you are maybe looking for short or looking for buys. You can see our price did not trade back to the up close candle. We just respected the breaker and we ran and give us, you see, we have a 5.4 risk reward ratio, 5.4 risk reward ratio. So that was it for breaker blocks. You can go to your chart and look for it. As I already gave you a contest. You can see I gave you a context of how price swept Asian range high. You can see this is sections liquidity, price sweeping sections of liquidity, price sweeping out Asian range highs. Then you look for structure shift, then breaker blocks. So that's it for the video. See you guys in the next video. Thank you.